Are houses finally going to become more affordable in 2024? Or will falling interest rates lead to another housing boom? And why did all the housing crash 2023 predictions fall flat? These are the key questions I'll be answering here in my 2024 housing market outlook. Since the vast majority of you are homeowners or prospective homeowners, not real estate investors, the main focus will be on affordability. But let's start with why all the doom and gloom predictions for 2023 were wrong. By the way, this played out pretty much exactly as I said it would back in December 2022. Check this out.
If you just type something like housing market into YouTube, you'll see that almost every video has some extreme superlative in it that's designed to scare you. Let's take a look. We're in a housing affordability crisis. 20% correction is coming. Huge changes coming to the US housing market. Redfin now shuts down and announces layoffs. Why 2023 will be worse than 2008. Mega crash. Okay, we get it. So let's dive into the top 5 false arguments for why the housing market is going to crash.
Over the past year, home prices are up about 4%. So why didn't they crash? I would point to 3 reasons. First, we didn't have the recession that was so widely predicted. The reasons for that could be a whole video in itself. So I don't want to get too far off track here, but often house prices fall in a recession, and we didn't have one. Second, home prices, like all prices, are driven by supply and demand. All the headlines about declining affordability and declining transactions show declining demand, but they missed the other half of the equation. Supply also fell because people didn't want to sell their homes after locking in low interest rates. That falling demand and falling supply kept the market in relative equilibrium. And third, well, you can go back and watch the video if you want the details, but sensationalist headlines often don't have a ton of merit. And those were no different. So what should we expect for house prices in 2024? Well, overall, I don't expect any extremes. Most likely, they'll rise a few percent. If we have a recession, they could fall a few percent. And realistically, house prices are very location dependent. So those numbers probably won't mean a whole lot to you, even if I could predict them with perfect precision. I think in general, the more affordable markets could continue to do well because interest rates aren't as much of a deterrent there. For anyone who's been in their house for more than a year, it's hard to move to a different house with the same value because it will almost certainly cost a lot more given the higher mortgage rates. However, people who bought a house a few years ago in an expensive place like California can still upgrade if they move to a cheaper place like Texas. Most people have a lot of equity in their homes after the last few years of price rises. So a lot of times they can pay cash for a house in a cheaper market and basically take mortgage rates out of the equation. House prices get all the attention, but I think for most people that want to buy a home, that's not the place they should be focusing. The reason I say that is because I think in 2024, houses are going to get a lot more affordable, regardless of what happens to house prices. There are 2 main components to a monthly mortgage payment: the principal, which is based on the value of the home, and the interest, which is based on mortgage rates. Let's put things in perspective here. On a $1 million home with a 30-year mortgage, a 1% fall in interest rates is the equivalent of a 10% fall in the price of the home. And regardless of what happens with home values, mortgage rates should be coming down. Actually, they already have by over 1% in the past month. There were a few false peaks in 2022 and 2023, but I think this one is the real deal. There are 2 main components to mortgage rates: the interest rates on long-term treasury bonds and a spread, aka additional yield over that. Now, we all know why interest rates have come up so much the last few years. The Fed has been trying to fight high inflation. But did you know the spread on mortgage rates over long-term treasuries has also nearly doubled from its historical norm? This chart is showing the difference between 30-year mortgage rates and 10-year treasury rates. You can see that for most of the past 20 years, the spread has been around 1.5 to 2%. But recently, it's been more like 3%, a level it only briefly hit in the 2008 housing market crash. There are 4 reasons why mortgage lenders have decided to raise mortgage rates so far above treasury rates lately. First, interest rates have been highly volatile. If they lend money out for 30 years at 4%, and then 1 year later interest rates go to 5%, they're basically underwater on the mortgage until interest rates come back down. When interest rates are more volatile, they need more cushion over the existing treasury rates to limit their risk of that happening. Second, the yield curve has been inverted. That means short-term interest rates have been higher than long-term interest rates. That's a problem because banks tend to borrow money at short-term rates and lend money at long-term rates. If short-term rates are higher, they lose money. Now, it's not quite that simple because some of banks' borrowing costs them virtually nothing, like what they pay you on your checking and savings account. And some of it is at the prevailing short-term interest rates, so they need an extra high spread over long-term rates to make money. The third reason mortgage spreads have been high lately is because prepayment risk is so high. Usually, mortgage lenders package a lot of their mortgages together as mortgage bonds and sell them to investors. But unlike most bonds, which have a set maturity, mortgage bonds carry what's known as prepayment risk. That's the risk that when interest rates fall, everyone will refinance their mortgages right away and the bondholders won't be able to collect those high rates for as long as they thought. Bonds do well when interest rates go down, but with higher than normal prepayment risk, lenders have decided to juice up their profits a little with higher rates because they know the good times won't last that long. As soon as rates start to fall, a lot of those 30-year mortgages at 7% are really going to turn into 2 or 3-year mortgages. The fourth reason that mortgage spreads have been higher than normal is that lending activity has been so slow. Every mortgage lender has fixed costs, like, to keep the lights on. Well, those costs used to be spread across like 50 million loans over the last few years. But in 2023, it'll be more like 4 million or a little less. So to recap, the two main components of mortgage rates are the yield of long-term treasury bonds and the spread on top of those. Treasury rates have been higher because of higher inflation, and spreads have been higher because of higher interest rate volatility, an inverted yield curve, higher prepayment risk, and less lending activity. So where might mortgage rates be heading in 2024? Well, starting with the long-term treasury rates, we already had a move down of about 1% over the past month or so, and we saw how that fed through to the mortgage rates. From here, I don't expect 10-year treasury rates to come down much more unless we have a recession. For more detail on why, check out my 2024 bond market outlook video. On spreads, however, I do think there should be some downward movement in 2024. How many times the Fed will cut rates in 2024 remains up for debate, but it's very likely they will be cutting them, which should make the yield curve less inverted. Remember, Fed rate cuts refer to the Fed funds rate, which has a more direct impact on very short-term interest rates than it does on longer-term interest rates. The lower mortgage rates go, and remember, they've already fallen 1% from their peak, the lower the prepayment risk will be. So that pressure should ease in 2024 too. And with lower rates, lending activity should pick up gradually. Put all that together, and I think it's pretty likely that mortgage rates will keep falling in 2024, and houses will become more affordable, even if house prices go up. If you want more investment insight from me, join my free Discord. The link is below in the description. Make sure you also check out my stock market outlook for 2024. I published it before this one, and my next video will be my bond market outlook for 2024. Thanks for watching.